Candle Range Trader back with a video on how to keep losses small. Let's get right into it. So this is the blueprint to staying alive. These are the tips, and I'll go over each of them in a little bit of detail. So some of these rules are specific to narrow range breakouts, but regardless of the strategy you trade, you may be able to take some of them and use it. So number one, the start and stay rule, where when you have a breakout, it needs to stay out of the range. And it's consequential initial risk. Start and stay rule for the 1 hour candle. Adjusting your stop loss with additional entries, type stop loss logic, and a time pace stop loss. So first off is the start and stay rule. So what does that mean? So we see here we have a very simple narrow range here on Monday. So Tuesday will be our trading day where we're looking for a breakout of the range. And start and stay rule just simply states that when price starts to break out of the range, when it closes above the range, okay, of yesterday's high, it needs to stay above it. The minute it closes on the 1 hour chart, or if you even want to do on a lower time frame, that's fine too. But if any candle closes back inside the range, that is your sign to get out before the stop loss even gets hit. Now, following this rule in this example, pardon me, would have been a 6 pip loss, right? So hopefully you're not betting like $100 of your account, unless you have like say a $20,000 account. But I mean, hopefully you're not betting the majority of your account on like a 20 pip stop loss. But losing 6 pips to try to earn 50, that's always the odds are in your favor at that point. Okay, so start and stay rule. That's just your signal to get out. You don't have to let the trade hit your stop loss no matter where it is. So, and typically what I like to do in this example is if the entry were here, with the breakout candle being this long green candle here, the stop loss could just go below the candle that made the breakout. That's one way to set your stop loss. But as you can see, you stop yourself out early and you don't have to worry. You keep all this upside, or you keep all this, you protect your equity from the account or the price hitting this level down here where the stop out would have been. So all this gap here, you save that. So next up is inconsequential initial risk. In other words, having such a tiny risk up front that it just doesn't matter. And then you have it in your mind though that okay, as the trade goes into my favor, I'm going to be sure to add positions. But just to start out, say for example, if you have a $200 account, maybe your first trade is worth like $2. That's nothing. So if it goes against you immediately, you might not even lose the whole two. But as well, like I said, you have it in your mind that as it moves into your favor, you can't be afraid to add to it. Because even if you get let's say you have a 1 to 5 risk to reward ratio, but you risk $2 to only make $10, you could do much better than that. But again, it's tied to adding to the trade. So you're free to add. And worst case scenario, combining the two, if you have an inconsequential upfront risk and stick with the start and stay rule, you start to combine some of these rules and say, okay, maybe you're adding positions in here. But even still, once price goes down, you can still just exit right here instead of letting the stop loss get hit completely, right? So that's how you would try to control your risk and just actively manage the trade. Next up, the start and stay rule on the 1 hour candle. I trade the 1 hour chart, but if you want to have a start and stay rule on the time frame that you trade, that's more than fine. So let's just say there are some times where people do not wait for the candle to close. Now, waiting for the candle to close typically is best because sometimes you'll have like a doji candle that just have wicks on both sides. So you got someone who may have gone long up here that's trapped, someone who may have gone short up here that's trapped. But let's just say that this green line right here is the 200 EMA, and your signal to enter would have been price starting to show momentum to the upside. So you go and say, you know what, I'm going to go ahead and get in right here. The start and stay rule simply states that this green candle, this candle must stay green, right? Because it's showing momentum. The minute it turns red, you would go ahead and get out. And you could always get back in. Okay, so I hope that makes sense. So this is kind of like where if you're trading and the candle's still actively open, it doesn't necessarily apply to if the candle's closed, but should you just see price going to the downside or to the upside in this case, and you want to go ahead and hop in, your understanding would be, okay, I'm counting on this candle to close green because if it does not, then I'm going to go ahead and just hop on out. Okay, so that's the start and stay rule. If the candle you enter on starts a color, it needs to stay a color through the close. All right, so that's that. So next up, one of my favorite methods is adjusting the stop loss with additional entries. So we have here a simple NR4 range. Price gives us the initial breakout. It's a trending range. So your first entry could be here. And your stop loss could go above the high of the day. This right here was the high of this day. This was Tuesday. So this would have been a Tuesday trade. Now let's say you take another entry right here on the strong red close. Then you could adjust the stop loss down right here to this high, right? So you move the stop loss just down. Some people call it a trailing stop. I manually put stops. I don't do like a trailing stop with the broker. I don't do that. Okay, so you can adjust it down here. And then on Wednesday, you could take another entry off of this strong red close. So you have an entry here, here, and here. And then you set your stop loss above this swing high. This high, higher high, and lower high right here. This swing high pattern could create a level whereby you think, okay, price probably won't go back to that level. So I'll go ahead and put my stop here for this entry. And these other two, you've already locked in the profit. So even if the stop loss gets hit, it'll be a small loss on this one, and these two will be stopped out for a profit right here because your stop loss moved from here to here to here. So you can put them around like a daily open, daily highs or lows, daily open price, swing highs, swing lows, fair value gaps, just whatever flows your boat. You just have to find the level that you think price is just not going to revisit. Is it 100% though? Of course not. But again, this is about protecting capital. Okay, at the end of the day, to keep the losses small. Next up is simple tight stop loss logic. So it's okay to use a tight stop loss when you're trading breakouts because it is a system that is designed to capitalize on the momentum of a pair's move, meaning that we want the price to break out of this range. So this is Thursday and this is Friday. Price broke out of Thursday's range and did not come back. So we're expecting a fairly sizable move. Now, not necessarily like 1,000 pips or whatever, but maybe a 1 to 2 days of just some solid price action. That's what we want to see. Are we always going to get it though? No. That's why when we don't get it, we keep the losses small so that our account is still intact. So when this move does come, and it will come eventually, you can still take a trade and get in the market. Okay. So that's the point. And then you can also move the stops behind certain candles as you add into the trade. So this was the breakout candle right here. I know some people wait, and this was like a break and a retest, like you could have got in right here. But additional entries could have been added on strong green closes, like right here, or even here. And then you just move the stop loss, say behind this candle or behind this candle, either way. Right now, obviously, it's easier to set a stop loss once the trade is done. But while you're in the thick of it, you'd have to just have it in your mind that, okay, you know what? I'm going to go ahead and just add and adjust, add and adjust. Right. And I'm pretty sure there's a fair value gap right here. You can use that as a guide as well. So it's just up to you. Okay. So next one. I like this one. This is a time based stop loss. And a lot of hedge fund managers use this as well. So here we have a example of a long breakout. Okay. So this is the range on Monday, but price broke out on Thursday. Now let's just say we got a late entry, but we're here, and remember our start and stay rule. So we want to see price stay outside of this range. So if the range is here, price is up here, so we're good to enter long. Okay, now there's a big old fat fair value gap here that did eventually close. But here's the point. Let's say you enter on this candle's open right here. The clock starts, and within 2 hours, right, you need to see that trade being in profit. If it is not in profit, 2 hours after you enter, no matter where it is, you exit the trade. Okay. Even if the profit is minuscule, it's more allowable than it being a drawdown because if you notice, this is a 1 hour chart. Here's the entry right here in this red candle. So this would have been hour one. This was hour two, this small doji. You would have been in a small loss, right? So you just cut it right here. And I don't know what the pip value was here. It had to be minuscule though because the move wasn't that big. But then because we used a time-based stop, look at this. All of this right here, we don't worry about it. We're already out of the trade because we know that wrong way. This is the price action we're looking for right here, right? So from this entry right here, let's say you get in right here. This is 1 hour. This is 2 hours. That's a profitable trade. So I hold it, okay? Because that's what we're looking for. This is 1 hour. Trade would have been at a loss. This is 2 hours. Trade still in drawdown. That's a red flag. Get out. Okay. The momentum is not there. So that could be a time-based stop loss could be great in saving you money. Okay. So how it should look is something like this. Now I didn't include an account size in this, but the losses should just be completely just minuscule and inconsequential. So obviously I'm not going to read all of this, but you just see how small these losses are right here. But then when a big win does come and you get to scale into it, you can get a gain like this. Again, the small losses, that's just the cost of doing business, collecting data. But then when that breakout does come, you can do something like this or something like this. Okay, and then you got another loss right there. So all of these losses added up were only $59. These 3 wins, 1, 2, 3, were $277, right? So you only won 3 out of these 12 trades. But the goal is that you kept the losses small and kept your wins bigger than the losses. Okay. This one win makes up for all these losses. Right. But if you're losing, $20, $50, $100, then for your win, you'd have to be making 200, 400, 500 to make up for that. It's easier to make up for this type of stuff than it would be for losses to be bigger. So you just have to have it in your mind. Okay, the only way I can win big is I got to lose small. You got to be ruthless with this thing. You really do. All right. So in conclusion, okay, you have to be in the minority of traders who focus on mastering small losses. There is no need for me to make a video on big wins because the big wins, that's just a result of NR7 breakouts. Okay. They're going to be there. They're going to happen. You just don't know which one is going to pay out. So you just take, I don't want to say you necessarily take all of them, but take as many as you can as your account will allow you to. And when you see a red flag, just get out. Okay. You have to stay alive with enough equity to make it count. So when the winner shows up, okay, it will show up eventually. But will you have enough money to make that winner worth your while? You got to stay small till you can get big. Now, these are just some of my actual numbers here from one of my real accounts. Okay. So you see here, I'm not just talking about this stuff. These are my losses right here. Okay. But guess what? These 2 wins right here decimate all of these losses. Okay. But that's how it's got to look. Okay. This is just cost of doing business. It's like almost like paying a tax. Okay. But when I win, something like this, well, this is just inconsequential, right? You only need a few of these to make up for all of these. But it does take some programming on our parts to get used to, oh, that's a small loss. Oh, that's a small loss. You always have to believe that, you know what, the next trade could be a winner. Okay. But until then, I will deal with this. And I'm not saying this style of trading is for everyone. It's just that if you want to win big, you gotta take small losses. You just have to. It is what it is. All right. So I appreciate your time and attention. Use one of these tips, use all of them, use none of them, but you got to get a risk management plan in place. But I appreciate your time and attention. Thanks so much for watching and have a great rest of your day. Take care.